Three, two, one. Hello, everybody. Welcome to the Capital Gains Tax Solutions podcast, where we believe most high net worth individuals and those who help them, they struggle with clarifying their capital gains tax deferral options. Not having a clear plan is the enemy, and using a proven tax deferral strategy such as the Deferred Sales Trust is an amazing way for you to exit high-end luxury primary homes or investment real estate or cryptocurrency or businesses, defer capital gains tax, not using a 1031 exchange so you can create and preserve more wealth. Hey, I'm your host, Brett Swarts. In each episode, I'm joined by some of the best real estate, financial, wealth, and business minds in the world, where they share their ideas, deal stories, and inspiration. Together, we can make complex tax deferral strategies simple and passive income plans achievable. I'm excited about our next guest. She's a repeat guest, and she has achieved a top producing agent at Sotheby's International Realty in Los Angeles, the top national 1%. And she's also selected by the Altman brothers, the stars of Bravo's $1 Million Listing, and to join them and the Douglas Elliman real estate team as well. And in 2002, the Altman Brothers team sold over $1.5 billion in real estate, and Julia has personally sold over $250 million now in luxury real estate and so much more in the Hollywood Hills and Beverly Hills. Please welcome to the show with me, Julia Delorme. Julia, how are you doing?
I'm doing well, thanks. Thanks for having me.
Absolutely. Great to have you back on the podcast. And for our listeners getting to know you for the first time, could you give us a little bit more about your story and your focus?
Right. So I started at Sotheby's and then I went to Douglas Elliman, and I've been on this team that's also shown on Bravo's $1 Million Listing Los Angeles. It's been on TV for 14 seasons. It's kind of a big deal. We were before Selling Sunset. If you're a fan of Selling Sunset, we're better than that. I'm excited to talk with you again today because I have a lot of clients that are always looking to defer taxes. So excited to get going.
Absolutely. And in our last episode, we dove into your even more of your story, kind of the secret of selling high-end luxury homes. So you guys can check that out on YouTube or the podcast. And this one, we're going to get really tactical, just some deals that actually have been happening or working on together, so that if you're watching this and you're potentially selling something with Julia, you're going to get a hands-on, practical approach of how to defer capital gains tax. So Julia, I think let's dive right in. You want to start with a case study to start, and then we'll work our way through it?
Yeah. So we've been talking about, a client in Beverly Hills who has a property that's easily worth $13 million. He bought it a number of years ago, so his cost basis is extremely low, and he's never heard of a DST, a Deferred Sales Trust. And so we are been talking with him about how it works. And I just wanted to talk with you again about some of those objections that he's thrown at me, and then I'm going to send this clip to him.
I think that's perfect, right? It's a great way to do it. And so let's talk about the stats here. I think you said it was worth $13 million before we started the show. He has zero debt, and we estimated the basis to be about $1 million. This is maybe like a tear down, right? But in an amazing location. Are those the fair summary of the stats?
Yes.
Okay. So let's break that down. So California, right? If it's a primary home, you're looking at least, 13.3%. Plus you have the federal of 20%. So you're about 33. And that's just on the minimum of the gain, right? So on this scenario, we're taking 13 million minus 1 million. That'd be a $12 million gain. And let's take, 33% of that. Okay. 33% of that. So, what's at stake here is about $4 million, $3.96 million. So first thing, Julia, do you find that this is an objection for people? They say, hey, I want to sell, Julia, but I don't want to do a 1031 exchange. It's a primary home, or even if it was an investment property, they don't necessarily want to have to go buy another property. Just talk about some of those frustrations you've seen with your clients over the years.
So this is typically elderly people, and I can talk to them about the benefits of Prop 6090, where they can take their property tax basis with them wherever they go, in reciprocating counties, which was expanded a year or 2 years ago. So now they can go to places like Montecito. They didn't used to be able to go there. That's very exciting to them, but the amount of tax they have to pay, they decide, you know what, I'm just going to sit put. So I want to, understand how this can be more of a vehicle for them to sell, because that is what I do, sell.
Exactly. So that is what we're trying to solve for, right? And at the end of the day, I like to say we're not necessarily here to sell real estate, although we do and help people with tax deferral, but really here to solve problems. If you think about it, it's like a Rubik's Cube. And the problem is there's $3.96 million in tax if you sell without having a tax deferral strategy. So how do we, create something that's going to give them not only tax deferral, but also maybe some liquidity, some diversification. And a lot of these clients too, they want to just retire, Julia, right? They don't necessarily need or want all of the capital at once, although they want some cash flow. A lot of these properties, they're really, real estate rich, maybe cash flow poorer, if you will. And so to be able to unlock this capital and put it into cash flowing, producing assets can actually really change their retirement and their ability to live a different lifestyle they want to live. So, Julia, what's the first question you think someone who's listening to this right now would have about the Deferred Sales Trust, and where should we start?
How much can you possibly collect in income on the proceeds that are being put in the DST?
Great question. So our typical structure of the Deferred Sales Trust would be in this scenario, we'll use, no debt, and the sale is 13 million. And depending on their risk tolerance, the returns are generally between 5 and 8% net of recurring fees. And it's not a guarantee or a promise, but it is something that we're going to try to achieve with a third-party financial advisor to manage the capital. And so just roughly, if we had 13 million in there, and let's just say the risk tolerance was average about 6%, that's about $780,000 in cash flow. Now that cash flow, if they receive it in the same year, would be taxed as ordinary income tax, if you're wondering. And most of our clients just live off of the cash flow or the interest payments, if you will. And they keep that 13 million intact, which would include that about extra 4 million or so in capital gains tax. So does that answer the first part of the question, Julia?
Yes, it does. And what if they wanted to take a portion of that out after a period of time, or maybe immediately before, right after it goes into the DST? Are they taxed on that as though it was capital gains?
Great question. So yeah, we do have clients often, or sometimes they need or want some of those funds for a down payment, like on a primary home. And that's totally fine, except you're going to pay tax on that amount. So let's just say, for example, it was a $13 million sale and they say, hey, I need at least 3 million for a down payment on my next house. We would schedule a payment at the close, basically right after the close of escrow, of 3 million to go out. That would be taxed, right? So that would be taxed as capital gains taxes. That's a principal amount. And then the rest of the 10 million can stay in a deferral state. And so it just depends. Are you taking principal? If it's principal, it's cap gains tax. Are you taking interest? If it's interest that's been accruing and earning and paying you, then it's ordinary income tax.
Okay, got it. Okay. So if it's principal, it's cap gain tax. And if it's interest, but of course you're not going to accrue that much interest in your first year, but if it's interest, then it's ordinary income tax.
Exactly right. That's the whole point. So sometimes people will wait maybe a year before they start pulling interest from the trust and delay some of that income tax, which is pretty cool. Some of our clients are moving out of California and establishing residency, let's say in Nevada or Texas or Florida, where it's a little tax lighter, right? And start to receive that income there. But the cap gains tax will always follow whatever state you left. So it's never going to leave there, which is why a lot of our clients like to just keep the principal intact and just live off the interest. And these are, by the way, just so people understand, what you're doing is you're loaning these funds to the trust in exchange for a promissory note. You're becoming a lender or the bank. And this trust owes you back the money plus a rate of return. Right. And you don't receive or pay tax until you receive payments. So that's how this whole thing works. And these notes are typically 10-year notes. And every 10 years, you can renew for 10 years. You can pass it to kids. But a lot of our clients like to live off the interest payments. But there's times when they might want to take a distribution larger than the interest payments. And there's ways to adjust the promissory note to make payments to them. And so, yeah, every circumstance is a little bit different, but that's kind of the general rule of thumb. Okay.
And then what are these reoccurring fees that you said? You said 5 to 8% net of reoccurring fees. What are those fees?
Yeah. So it depends on the size of the deal, but I'll keep it simple. Let's say it's $1 million deal, right? And there's $1 million piece of property that's sold. Basically, it's $15,000 as a one-time fee for the tax attorney, and that's paid at the close of escrow. And that covers lifetime audit defense. By the way, thousands of closes over 25 years, over a dozen no change IRS audits, including California audits. So it's been through and tested, and they provide lifetime audit defense. And then on the recurring fees, it's about 1.5% to 2% on the net proceeds. So if the net proceeds were $1 million into the trust, it'd be about 15 to 20,000. That includes the trustee, which is our role, and then includes the financial advisors that we work with to do that. Now, as the value of the trust goes higher, we do have some fee breaks, but that's the general fees.
1 to 2.5% every year, annually.
Every year, yes.
And is that pretty comparable to what a financial advisor would charge?
It actually is. And if you actually take and we'll look at a trustee by themselves, a corporate trustee, it could be as much as 1.25% to 1.5% by themselves, and a financial advisor, depending on the amount under management, could be 1% or so or more. And so combining, we're trying to keep it institutional as we can to combine those two roles together, because part of the integrity of the trust is having a third party unrelated trustee, which is our role here at Capital Gains Tax Solutions and my role. And so, yeah, it is very competitive. In fact, we would say even more competitive. On top of that, a lot of our financial advisors are fee-based financial advisors, and they're able to buy things at what's called NAV, and there's not a lot of load or extra, hidden fees or commissions. So we try to keep it very institutional for the clients.
And like, how does this work? This might sound silly to ask it this way, but I mean, do they have is it in a bank that they can access? Do they have an ATM card? Like, is it as simple as that?
Great question. So there's a concept called Constructive Receipt, which means they have to give up some control, right? In other words, think of it like a 1031 exchange, Julia, where if you were selling a property, the funds go to a third party, qualified intermediary. That's sort of like what the Deferred Sales Trust is with Capital Gains Tax Solutions. In fact, we use a big bank out of Irvine, a $16 billion bank is one of the banks, and we also TD Ameritrade, Charles Schwab. So the funds are going to a third party institution. The funds are never commingled in other accounts or any other trust accounts. These are single entity trusts, and they have 24/7 access to view the funds online. But it's not something they can click a button and move, because if they did, that would be what's considered constructive receipt, meaning it's taxable. But on the other side, we have safeguards in place where they have to approve, along with the trustee, myself, in order to keep the integrity of the trust. So it's checks and balances there. And that's also why we have a third-party financial advisor in place.
Right. And I think that was one of his concerns, right? The example that we were talking about when we started this call is not having full control, but it makes sense what you're saying, because you can't have full control. To have full control would mean constructive receipt, and then you would be, you would have tax consequences because of that. So what are some of your accolades, your, right, whatever you can share for somebody to feel confident that you are a safe place?
Right. Absolutely. So it's a team effort here, right? And one of the beauties of the Deferred Sales Trust is there's really three major parties. There's the tax attorney, we call them the brain surgeon, who's doing all the legal and all of the structuring. There's a separate trustee, third-party trustee, separate from the legal team, that acts as kind of like the qualified intermediary, if you will, and keeps the money from being constructive receipt and being in the business of buying assets and selling assets, and then having a seller, owe the seller the money. And then there's the financial advisor. And so what this creates is kind of like if you think the three branches of the government, right? And they're separate, and they all each have their own role, and they're each kind of looking at one another, right, to make sure that you're doing it correctly. In fact, I would make the argument that when you have more parties, especially if they're not all under one roof, you actually have more security, more safety, because a lot of people would have to be doing a lot of bad things, as well as third-party banks that we use, as well as, the money goes to some of the biggest financial institutions in the world, TD Ameritrade, Charles Schwab, when they're investing funds. And so, so it would take a lot of that. Now, that being said, I've never been sued. I have a really good, great credit score, right? Clean background, all of those things. There's a lot of vetting that went on before I even became a trustee. I happen to be a California real estate broker myself. I started out at Marcus and Millichap selling multifamily properties, and closed a lot of deals, done a lot of business. So I think the biggest thing is people getting to know, like, and trust us by spending time with us, speaking with our clients, understanding the structure, of course, bringing your CPA in to vet us as well and talk with us, and to know that there's a team here that's involved. And once you have that, it becomes more, you can become more comfortable. But the aspect of the third-party trustee is really important here. Like, a lot of people want maybe, I want the trustee to be someone who's in my family, or, my brother-in-law, or, someone my secretary outside of my office. I think all of those things that create the tax deferral, those kind of things eliminate the tax deferral because you have what's called too much control, if you will, right? So you do have to give up control, right? That's absolutely true, except you also have to approve of the collateral, approve of the movement of the funds, but also the trustee does as well. So it's like riding a bike. I tell clients it takes time, but once you're riding the bike, you're like, okay, I get it. I feel comfortable now, but it's not something that happens overnight. You got to spend some time with us.
And we were talking about this before, but out of those three people, you can elect to have your financial advisor be one of those three people on this team if they go through, right, and get certified.
So let's talk about that. So the estate planning team is the exclusive kind of for the financial advisors and everybody, and we're members of that. And they're actually out of Southern California. And one of our strategic alliances is down there in Dana Point, Indian Wells, and they're amazing about doing the compliance and the training. And so if a financial advisor has clients or is interested in joining and becoming a part of the team, if you will, they can join, get certified. And it doesn't mean that they move their firm, right? They start their firm, they just become a member of the estate planning team. And that unlocks their ability to manage deferred sales trust capital. Okay. So if someone's looking at this, perhaps and they're selling a house in 3, 6, 12 months, and they're considering it, could they share the deferred sales trust with that financial advisor and then they contact us and we, go through the process? Yeah, absolutely. But it's not a situation where if we close the deal, Julia, then they say, well, I want to send it over to this financial advisor. What that creates, and we're going to be cautious of the constructive receipt part again, right? Where it's too much control and even if it's not a related party, we err on the side of being very conservative with that. And so I would just say, have that financial advisor contact us. Let's talk about it. Let's go through it and go from there. If that makes sense, Julia.
Okay. This is another pretty elementary question, but I want to ask it. I've always wanted to know why this is the case. So if I tell somebody about a DST, they immediately think of a different type of DST. But I say, no, Deferred Sales Trust. What is the other DST that comes up on Google?
Great question. It's a Delaware statutory trust, right?
Right.
And a better way to think about it is it's a Delaware 1031. And so 1031 exchange is for investment property. And that's when you can sell an investment property and trade it to a like kind investment property within 180 days. And there's a thing called a Delaware statutory trust, which again, better way to put it is a Delaware 1031, where you're selling an investment property and you're moving it into like a big syndication, if you will, or a big partnership with maybe 1, 2, or 3 properties, typically Class A properties. But you give up literally all control, all liquidity, all diversification. They're typically tied up for 5, 7, or 10 years. Huge fees, by the way, huge fees. And so, by the way, we sometimes help people with the Delaware Statutory Trust. They have their pros. Definitely, there's some pros to them. There's no management responsibilities. In other words, it's a third party who's doing it all. They're typically, it can be some very strong operators, really good locations, but the returns typically aren't that great. They're also typically non-recourse loans, but they do have their place. And sometimes we're using this for mortgage over basis issues. But again, it only applies for investment real estate. So if you're selling a primary luxury home with you, Julia, they don't even have that option anymore unless they wanted to try to move out and rent it out and do that whole thing, right? And become an investment property. So this is what the ability of the Deferred Sales Trust is so nice, is that it works for primary homes. In fact, we just did an $8 million deal in Palo Alto for a primary home. There was an over $20 million deal in Newport Beach that was a primary home that was done. It also works for cryptocurrency and business sales, whereas the Delaware 1031 or traditional 1031, that only works for investment property. It's just that one niche, right? Whereas the Deferred Sales Trust is super flexible. The other nuance here too is you can dollar cost average with the Deferred Sales Trust. There's no like kind replacement. There's no equal or greater value. You don't have to take on any more debt if you don't want to take on debt. You can put it all into the biggest companies in the world and diversify your equity. You can also put it back into real estate if you want to, or other business ventures. So it's very flexible and entrepreneurial, and it gives you the ability, especially if you've, think about it, Julie, if you live somewhere for 39 years, I think the next deal we're going to talk about here in a minute, and all of your capital is tied up, and you're getting older and you're wanting to expend that money or have access to it or have diversification. You don't want to put it all into just one asset class and one property and one location with one group. You want to be able to diversify with some biggest companies in the world and also some real estate as well. So we love that it provides that kind of that safeguard, that safe harbor, if you will.
Okay, so can we talk about alternatives to a DST? We just talked about the difference between a Delaware statutory trust, which is not a DST, but I've had clients talk to me about a charitable remainder trust.
Absolutely. So one option for people, if you're charitable inclined, which is great if you are, all our clients are as well, is using something called a charitable remainder trust. There's also things called like donor advised funds, where you're able to get capital gains tax deferral and or complete elimination, depending on how you structure it and set it up, and some income tax deferral. So these are all needed, by the way, need to be set up prior to the close of escrow. However, the biggest thing with the CRTs, if you will, is you're going to irrevocably basically give it away to a charity upon your death, which most of our clients are charitable. They're just not 100% charitable. And with the deferred sales trust, you're welcome to be charitable, but you can be charitable at your own terms. And what does that mean? Well, you might have an distribution of $780,000 in 1 year, and you might turn around and just write a check for $500,000 to a charity that you support, and you're going to get that offset in that tax, right? But that charity might change, values. So I mean, mom and dad might support someone in 10 years, the leadership's completely flipped, Julia, right? And so if you've irrevocably given it away, you're giving up that control and that accountability to be able to hold the people's feet to the fire. Now, donor advised funds help with that because you can change some things around. So you really got to define what are you trying to solve? And if you want to leave more for the kids, or you want to do maybe a partial CRT and a partial deferred sales trust, we sometimes we can work on those type of scenarios. So we like to see the DST is like the CRT, just no C is required. So that's kind of the main difference there. Does that make sense, Julie? Any questions or thoughts on that?
What about the interest that you can collect? I understand that it's always a fixed 5%. Is that correct?
That's a good point. So that also, depending on how you set up the CRTs, they're also typically very restrictive in the investments themselves. So for example, we can partner with the trust and we can buy real estate with the trust and do business ventures with the trust, with the deferred sales trust. With the CRTs, my understanding is they're typically very conservative in their investments, not as flexible and not as entrepreneurial. So you have to ask yourself too, like I have clients where they say, like, I want to support my son's or my daughter's business venture with a part of the deferred sales trust. Can I go into partnership with them to go buy or real estate or do deals? The answer is yes. The CRTs, I can't say for certain that you can't do that, but the ones that I've seen people and why they typically choose the deferred sales trust is because of what you just said. They're so restrictive, and it's typically just stock market stuff, right? Which a lot of our entrepreneur, real estate clients want that flexibility to be able to go back into other deals, if that makes sense.
Not to mention that charitable remainder trusts are capped at 5%, right? And
they can be, yeah, they can be capped at 5%. I think some of it depends on how you set it up, and some of it can be based upon your life expectancy, as and then it could be, again, we like to call those the Netflix version. It's kind of like the 1031 is Netflix because you have to go back into like-kind real estate in a short period of time. The CRTs generally are very restrictive in what you can invest into. Yeah, they can be capped at certain amounts, but it's not a one-size-fits-all. Certain people do it different ways, but yeah, generally speaking, it's like Blockbuster versus Netflix, or with the deferred sales trust, you have tons of flexibility. You can be more entrepreneurial. You can earn higher interest based upon your risk tolerance. But yeah, we're happy to go through both side by side for folks to help them, get a good, clear understanding of both.
You walk me through an example. If a client put their funds, their net proceeds, they sell their house, it goes into, they establish a trust, they sign up with you. There's 3 people on the team. Maybe it's their financial advisor. Maybe they've taken the course. So they're a part of this 3-man team. The proceeds go into a financial institution where it's under the trust. Let's say they want to, so let's say they're collecting 5 to 8%, net of reoccurring fees and income, and now they're ready to buy a new home. How does it work from there?
Perfect. So if it's a primary home, right, and let's say it's a couple of years after they waited for the market to cool off, right, waited for interest rates to cool down a little bit, and so now they're ready to buy a new home. And let's just use this example of the 13 million was in the trust to start, and let's say they needed a $3 million down payment. So we can amend the promissory note, okay, to make a distribution of, let's say, additional $3 million. Now they'll pay tax on that, right? So it's amendable and adjustable along the way, depending on on which structure we use. By the way, there's really two structures. There's a DST 1.0 and 2.0. 2.0, by the way, is very valuable for people. This is a good time to bring it up, who have estate tax challenges. So for ultra high net worth clients that are worth more than 24 million married, Julia, they're going to be subject to what's called a 40% death tax for anything that's inside of their taxable estate. By the way, those exemptions are set to cut in half to 12 million here in 2025, maybe even lower for a married couple. And so you have to also ask back to the Rubik's Cube scenario, like what problem are we trying to solve for? Well, they say, well, I want to buy a primary home. Okay, great. But also, are the funds outside your taxable estate, right? And what's your tax situation? And we're going to try to customize probably one or two trusts. The first one being for income tax deferral and capital gains tax deferral. The second one being for portions of that, but also estate tax elimination. Okay. So depending on which structure we use, and sometimes we use a combination of both, we might adjust the DST 1.0 to pay out that amount, pay tax on that, go spend it on whatever you want. So that's the general way that we would do that. Does that make sense, Julia?
Did you say 40%?
Yeah, so death tax is 40%, and it has nothing to do with the stepped up basis. Let me give you a clear example. Let's imagine a client is worth $100 million and all $100 million is in real estate, and it's tied to, it's inside their taxable estate. Now let's imagine they're married, so they get a $24 million exemption. That leaves $76 million inside their taxable estate, Julia. So you take that by 40%, that's $30 million that's due upon 6 months after they die. So even if they get a stepped up basis on that $100 million beautiful asset on the, on the coast of California, they're subject to $30 million if it's inside of their taxable estate. And so the solution is you sell that property for them prior to them dying, right? Is really what it takes. And moving it into what's called the DST 2.0 or DST plus. And that eliminates the estate tax. That 100 million gets outside the taxable estate so their kids can inherit it estate tax free. It's actually such an amazing way to keep generational wealth in the hands of the people versus it all going to the government. And so, yeah, it's by the way, one of the biggest deals was done in San Diego, $100+ million deal that was done years ago. And so yes, we can do that for people.
If you're dialing it all the way back and somebody is considering paying, potentially 33.3% in income tax or capital gains tax, right? And they have a $500K exclusion because they're married versus not having access to that money, potentially making 5 to 8% net off of whatever is invested and paying 40% every time they take money out.
Yeah, it's a no-brainer, right? That's where once the deals get large enough, like the idea is it's no longer just about cash flow, Julia, it's about tax flow. Because guess what? 30 trillion in debt, the government, and taxes are going higher and higher and higher. And so the largest wealth transfer in the history of the planet's happening right now. And that's the baby boomers that are passing all of the wealth down to the millennials in the next 20 years. And the question is, how is that going to transfer? And it's just a mathematical equation. Yeah, you're looking at minimum 33, probably maybe even 37 to 40% of its investment property or more with the depreciation recapture in California, plus, or other high tax states like New York. Plus, if you're looking at estate tax, which has, again, nothing to do with the stepped up basis, that's a 40% death tax on top of that. It's astronomical. And so you've got to have a team who's going to help you execute and do all of these things. Otherwise, a lot of your wealth is going to go away to the government.
So who is your ideal, or rather, I should say, who is the person that benefits the most from this setup? Is it, you just mentioned one, somebody who's passing on generational wealth. What about the consumer? Are they moving to Arizona or a no income state to really benefit from, the income tax that would occur if they withdrew from their trust?
Yeah, let's talk about how to make the deferred sales trust an investment and not an expense, because that's the biggest thing in people's minds, right? So the first one obviously is the income tax deferral and capital gains tax deferral for a period of time. We kind of touched on the estate tax elimination for the DST 2.0 for ultra high net worth people. The other one too has to do with of course, diversification, right? They're looking to not have all of their eggs or all of their assets into one product type or one location or one property. and they're wanting to also have some liquidity. They're not wanting necessarily to be in a marketplace where it's starting to turn, right? And the question is, how hard is it going to turn, and how long does it take to get back again? I mean, we're on like a 13-year bull market run, and now all everything's starting to change. So I think you've really got to value diversification, liquidity, paying off debt. You got to value, cash flow, but also the entrepreneur client, right? If they want it, I have clients that have sold, cryptocurrency, for example, at $5 million when Bitcoin is 54,000 a coin. And they use a large percentage of that to do a startup business, like a Khan Academy online. It's a tech company with a college roommate. Like that was her dream. Her dream was to retire from Silicon Valley, working for a big tech company, and start her own educational online platform. So she used the capital that she would have paid a tax, all tax deferred, to fund that. I call it the go fund yourself. So every client's circumstance is a little bit different. Some of our clients just want to get rid of the toilets, trash, and liability, want to travel more, want location freedom. At the end of the day, the Deferred Sales Trust is customizable to give efficient tax flow and cash flow to unlock those dreams and those desires for those clients. So it's not a one size fits all, Julia. We really like to get to know the client and what they're trying to do, what they're passionate about, and then try to reverse engineer how the trust is going to help them accomplish that.
Right. It's probably not going to be the person who's buying the index, right? In stocks. It's somebody who, like you said, is a little bit more entrepreneurial, that wants to diversify and wants cash flow.
Yeah, that's a good way to put it. But it could also be someone who I have clients that get out of real estate and they said, I never want to touch real estate ever again. I mean, a client named Charles, he was in Tucson, Arizona. He was a student housing apartment complex for a couple $1 million. He's like, Brett, put it in the biggest companies in the world. I never want to touch a piece of real estate ever again. And I go, what are you most looking forward to? And he goes, Brett, not having to get that call. There's always someone calling about something. And I go, well, didn't you give it up to property management? He's like, Brett, you wouldn't imagine people who don't really care about, your property like you do. So I tried that for a while, but now he's like, if these biggest companies in the world fail, the Home Depots, the Googles, the Apples, right, the Microsofts, then I lose my money. But if they don't fail, like, I'm going to get this cash flow and I'm going to live peacefully in my retirement. So that's one client. Then I have other clients that are like, hey, Brett, I don't like the stock market and I'm very cautious about that. How do we maximize real estate investing in business ventures? And again, that's how we customize that to them, if that makes sense.
Yeah. Okay. Well, sounds like a good alternative, a great alternative. Everybody,
thank you so much.
Calling Brett and myself.
Absolutely. And so, Julia, if people want to get in touch with you, what's the best place for them to find you?
My first and last name, literally, if you just type that into Google, a variety of sites will show up. My website, my Instagram, Douglas Elliman site, Julia Delorme.
And that's Delorme. And that's, it's spelled Julia. And then also she's on Instagram, she's on LinkedIn. And if people want to get in touch with me, you can go to capitalgainstaxsolutions.com. We can start your no-cost consultation. Our minimum is $1 million net proceeds, $1 million gain. But we're happy to walk you through all of these scenarios. You can check out the new book too that's coming out soon. It's called Building a Tax Deferred Exit Strategy. And we have people like Kevin Harrington from Shark Tank in the book, and a number of other financial advisors and real estate experts as well. Julia, that being said, maybe we can do this again sometime, right? And we can go. Oh, do we want to go over that $13 million, the other $10 million deal who lived there for 39 years, real quick as a bonus? Or
she's the CRT that we talked about. So I mean, that's what she prefers to do. She's not very entrepreneurial. She wants to give it away to a dog shelter.
Yeah.
Love with dogs, doesn't have kids. So that's her path. But if somebody wanted to do a CRT, could they call you?
Well, we would refer that out to someone else because we niche focus, but yeah, they could call us and get the side-by-side scenarios and then we would refer it out. We have some great estate planning attorneys for that, for the CRTs. So yeah, happy to help people. All of what we do, by the way, is conditional. So we don't charge unless and if you use the DST. So we're happy to walk through the different scenarios for the Delaware, for the 1031, for the Deferred Sales Trust, for the CRT, for opportunity zones, go through it all to give you kind of a clear picture and then either point you in the right direction or execute on the Deferred Sales Trust.
You know what? I actually do have one other question on CRT. Sure. I was reading that you can have a maximum net of 5% per million.
Yeah, there's some nuances there. And again, I'm not closing these. I'm not as, honestly, like I would say 99% of the time, once people learn about the Deferred Sales Trust, they walk away from the CRT because again, they're not 100% charitable, but there are those that are. So We kind of, if they are that way, we say, hey, here's a good person to go to. And so those little nuances, Julia, I really don't know because I haven't closed those. I have closed Delaware Statutory Trust, 1031 exchanges, and Deferred Sales Trust, of course, right? So that's more like my wheelhouse, if you will. So yeah, there's definitely some limitations for those for sure. And that's most likely why people just choose us, if that makes sense.
Okay.
All right. Hey, thanks everyone for watching or listening. Please rate, review, subscribe, and share this with someone who could help out, because there's people out there that want to sell their luxury homes, and then hire Julia to do it. She's amazing at what she does. You can tell she's passionate about learning more things and thinking outside the box for her clients to solve problems. And that's who you want in your corner. So thanks so much for watching. And we